Listen to me carefully. Right now, as you're watching this, somewhere in the world a trader just lost everything. Not because they were stupid, not because they didn't work hard, but because they committed the one sin that the market never forgives. They entered at the wrong time. I've seen it happen 1,000 times. I've watched fortunes evaporate in hours because someone thought they could outsmart the tape. They couldn't, and neither can you, unless you understand what I'm about to tell you. The market doesn't care about your analysis. It doesn't care about your indicators. It doesn't care about the money you need to pay your bills. The only thing that matters is timing. Master it, or keep bleeding money until there's nothing left. I'm going to show you exactly how the professionals time their entries, and why everything you've been taught is probably setting you up for disaster. You want to know the real reason most traders fail? It's not lack of knowledge. It's not even lack of discipline, though that's part of it. The real reason is that they're playing a game they don't understand with rules nobody ever explained to them. They're taught to buy low and sell high, as if the market has a sign that says, this is low, and this is high. They're told to follow trends, but nobody tells them how to identify when a trend is about to reverse and trap them. They learn about support and resistance, then watch in horror as those levels get smashed through like they were made of paper. I should know. I've made millions and lost millions, and the difference between the two always came down to one thing: timing. When I was young, I thought I was clever. I'd watch a stock move up and I'd think, it's gone up too much, time to short it. Or I'd see a stock falling and think, it's gotten too cheap, time to buy. You know what happened? I got destroyed, over and over again, because I was fighting the market instead of reading it. The market was telling me exactly what it was going to do, but I was too arrogant to listen. I was imposing my opinion on price action instead of letting price action guide my decisions. That's what kills traders. Their ego, their need to be right, their stubborn belief that they know better than the collective wisdom of millions of participants putting real money on the line. Here's what changed everything for me. I stopped trying to predict where the market should go and started observing where it was actually going. I stopped fighting obvious moves because they seemed too extended and started riding them. I learned that the market can stay irrational longer than you can stay solvent, and that trying to pick tops and bottoms is a fool's game. The money isn't made by being contrarian for the sake of it. The money is made by recognizing when the market is in motion and positioning yourself in alignment with that motion at exactly the right moment. Not too early, not too late, but at that precise point where probability shifts dramatically in your favor. Think about it like this. Every major move in the market goes through distinct phases. First, there's accumulation or distribution, where the smart money is quietly positioning itself while most people aren't paying attention. Then there's the markup or markdown phase, where price starts to move in a clear direction. This is followed by the public participation phase, where everyone notices the move and jumps in. Finally, there's the climactic phase, where the move exhausts itself and reverses. Now, where do most traders enter? They enter during the public participation phase, or worse, during the climactic phase, right before the reversal. They're buying tops and selling bottoms because they're reacting to what's already obvious instead of positioning themselves ahead of the obvious. The professionals do the opposite. They're accumulating when nobody's watching. They're building positions during those boring sideways markets that put everyone else to sleep. They're entering when the technical setup is perfect, but before the move has attracted attention. Then, when everyone else is piling in late, they're already sitting on substantial profits and preparing to exit. This isn't insider trading. This isn't manipulation. This is simply understanding market psychology and timing your entries to align with where institutional money is flowing rather than where retail traders are rushing. Let me tell you about a dollar trade that taught me this lesson in the most painful way possible. It was cotton. I'd done my research, and I was convinced cotton was going higher. I was right about the direction, dead right, but I was wrong about the timing. And in trading, being right at the wrong time is the same as being wrong. I entered too early. The market wasn't ready to move yet. For weeks, my position just sat there, bleeding me through small losses and opportunity cost. I watched other opportunities pass by because my capital was tied up in a position that was going nowhere. Finally, I couldn't take it anymore and closed the position for a loss. And you know what happened next? Cotton exploded higher, exactly as I'd predicted. The move was there. The opportunity was real, but my timing was off. And that made all the difference between a massive win and a frustrating loss. That experience taught me something crucial. The market doesn't reward you for being right in theory. It only rewards you for being right in practice, at the right time, with the right position size. You can have the best analysis in the world, but if you enter before the market is ready to move, you'll either get stopped out for a loss or watch your capital sit dead while better opportunities pass you by. Timing isn't just important, it's everything. It's the difference between consistent profits and constant frustration. It's the difference between growing your account and watching it slowly bleed away, through death by 1,000 cuts. So, how do you develop this timing? How do you learn to enter at the point of maximum probability and minimum risk? It starts with understanding that price action tells you everything you need to know, not your indicators, not your oscillators, not your complex algorithms. Price. Pure, simple price movement. When I look at a chart, I'm not looking at what I think should happen. I'm looking at what is happening right now. I'm observing how price is behaving at key levels. Is it respecting support and resistance? Or is it slicing through them? Is volume confirming the move? Or is price moving on thin air? Are we seeing climactic volume that suggests exhaustion, or steady accumulation that suggests smart money positioning? The best entry points share common characteristics. They occur at moments of transition, when the market shifts from one state to another. Think about it. When does a stock that's been in a downtrend finally bottom? It doesn't just turn on a dime out of nowhere. First, you see the downward momentum begin to slow. The selling waves become less severe. Then you see a test of the lows where price holds, creating a double, bottom, or some other reversal pattern. Volume often spikes on this test as sellers exhaust themselves. Then, and only then, do you see the first signs of buying pressure. Price starts to hold above short-term moving averages. It starts to make higher lows. The character of the market changes from sellers in control to buyers stepping in. That transition point, that shift in character, that's where the professional enters. Not at the bottom, not after the move is obvious, but right at that inflection point where probability shifts. The same principle applies to breakouts. Most traders chase breakouts after they've already happened. They see a stock breaking above resistance with a big green candle, and they jump in, eager to catch the move. You know what happens next? The stock reverses, and they're caught in a bull trap. Why? Because they entered after the move, not before it. The correct way to play breakouts is to position yourself before the breakout occurs, when price is consolidating just below resistance, building energy like a coiled spring. You watch for volume to dry up, indicating that sellers are exhausted. You watch for price to hold higher and higher lows within, the consolidation, indicating accumulation. Then, when you see those first signs of buying pressure beginning to expand, that's when you enter, before the breakout, not after it. Your risk is clearly defined. If price breaks back into the consolidation, you're wrong and you exit. But if you're right, you catch the entire move from the beginning, not just the exhausted end of it. This is what separates professionals from amateurs. Amateurs react to what's already happened. Professionals anticipate what's about to happen based on how price is setting up. Amateurs chase momentum after it's obvious. Professionals position themselves ahead of momentum, then let the crowd chase the move and provide their exit liquidity. Amateurs enter based on hope and excitement. Professionals enter based on calculated probability and clear risk management. The difference in results is staggering. One group slowly loses money through poor entries and bad timing. The other group consistently profits by entering at points where risk is minimal and potential reward is substantial. Now, I know what you're thinking. This all sounds great in theory, but how do you actually identify these perfect entry points in real time? How do you know when the market is truly shifting versus when it's just a false move that will reverse and trap you? That's the million-dollar question, isn't it? And the answer is experience combined with systematic observation. You need to develop a sense for market rhythm, for the ebb and flow of price action. You need to watch thousands of setups form and play out so your mind begins to recognize the patterns intuitively. But more than that, you need a framework, a systematic way of evaluating whether a setup meets your criteria or not. Here's mine, and you can adapt it to your own style. First, I never enter a trade unless the broader market context supports the move. If I'm looking at a long setup, I want to see the overall market in a bullish phase, not fighting against a bearish tide. Going against the market trend can work, but it dramatically reduces your probability of success. So why fight with one hand tied behind your back? Second, I want to see clear evidence of accumulation or distribution at key levels. This shows up in volume patterns, in how price behaves at support or resistance, in the character of the candlesticks or bars. Third, I want a clear catalyst or technical trigger that will likely attract other buyers or sellers. This could be a breakout above a key level, a successful test of support, a moving average cross, or any number of technical triggers that tend to attract attention and create momentum. Fourth, I want clear risk definition. I need to know exactly where I'm wrong, and that level needs to be close enough that my risk is acceptable relative to my potential reward. If I can't define a clear stop-loss level that makes sense, I don't take the trade, period. When all four of these factors align, that's when I strike, not before. I don't take trades because I'm bored or because I feel like I should be doing something. I wait patiently for these high-probability setups where all the factors line up in my favor. This means I'm not always in the market. In fact, I'm out of the market more than I'm in it. I'm watching, observing, waiting for that perfect pitch. And when it comes, I swing hard. This is how you compound wealth in the markets, not by trading constantly, not by staying busy, but by waiting for those moments where the odds are stacked heavily in your favor, then committing capital with conviction. Most traders do the opposite. They take marginal setups, constantly because they can't stand being on the sidelines. Then they wonder why their results are mediocre at best. Let me give you a modern example that illustrates these principles perfectly. Think about how the big tech stocks moved during the various bull and bear markets of the past decade. Time and time again, you'd see the same pattern play out. A stock would go through a correction, pulling back to a key moving average or support level. The financial media would run negative stories. Retail traders would panic and sell. Then, you'd see the stock begin to hold at that support level. Volume would spike on down days, but price wouldn't break lower. Then, suddenly, you'd see a reversal day with strong volume and price closing near the highs. That was your signal. That was the market telling you that institutional buyers were stepping in, absorbing the selling, and preparing to mark prices higher. The traders who entered at that point, when it was still uncomfortable and uncertain, made fortunes. The traders who waited for confirmation, who wanted to see several days of strong upside before they believed the move was real, entered late and often got caught in the first pullback. This same pattern repeats across all time frames, in all markets, throughout history. Human psychology doesn't change. Fear and greed don't change. The patterns that work today are the same patterns that worked when I was trading 100 years ago, and they'll be the same patterns that work 100 years from now. The specific indicators might change, the technology might evolve, but the underlying dynamics of how markets move from equilibrium to momentum and back to equilibrium, those are eternal. Master those dynamics. Master the timing of entries and exits within those dynamics, and you have a skill that will serve you for life. But here's where most traders go wrong. Even when they understand these concepts intellectually, they know they should wait for high-probability setups. They know they should enter at inflection points rather than chasing moves. But in the heat of the moment, when they're watching a stock rocket higher without them, they abandon their discipline. They can't stand the pain of missing out, so they chase. They enter at exactly the wrong time, driven by emotion rather than logic. Then, when the inevitable pullback occurs, they panic and sell, locking in a loss. This cycle repeats over and over, and they never break free because they never develop the emotional control necessary to stick to their plan. Trading success isn't about having more knowledge than the next person. By now, the basics of technical analysis are available to anyone with an internet connection. The information isn't secret. The patterns aren't hidden. What separates winners from losers is emotional discipline, the ability to follow your rules even when every fiber of your being wants to break them, the ability to sit on your hands when there's no good setup, even though you're bored and eager to trade, the ability to take your profits when your plan says to exit, even though the position might go further in your favor, the ability to cut your losses quickly when you're wrong, even though admitting defeat is psychologically painful. These are the skills that matter. These are the skills that determine whether you survive and thrive or blow up your account and quit. And here's the thing nobody tells you. Developing these skills takes time. It takes screen time, watching markets day after day, month after month until the patterns become second nature. It takes real money on the line, because paper trading doesn't create the emotional pressure that reveals your psychological weaknesses. It takes losses, painful losses, that teach you what not to do. Every successful trader has blown up at least one account. Every successful trader has made every mistake in the book. The difference is that they learned from those mistakes instead of repeating them endlessly. They developed the mental database of what works and what doesn't through painful experience, and they used that knowledge to refine their approach until it became consistently profitable. So when I tell you that timing is everything, I'm not just talking about the mechanical aspect of identifying entry points. I'm talking about the entire package, the market awareness, the pattern recognition, the emotional discipline, the risk management, the patience to wait, and the courage to act when the moment arrives. All of these elements work together to create what looks like perfect timing from the outside. But it's not luck. It's not some innate gift. It's a skill developed through dedicated practice and painful lessons, and it's available to anyone willing to put in the work and pay the tuition the market demands. The question you need to ask yourself is this: are you willing to do what it takes? Are you willing to study charts for hours, not just looking for setups, but truly observing how price behaves in different conditions? Are you willing to keep a detailed trading journal, recording every trade, every emotion, every deviation from your plan, so you can identify your patterns and correct them? Are you willing to risk real money, knowing you'll lose some of it in the process of learning, but viewing those losses as tuition rather than failures? Are you willing to sit on your hands for days or weeks waiting for the right setup, even though it's boring and you feel like you should be doing something? If you can answer yes to these questions, if you can commit to this path, then you have a chance. If not, save yourself the pain and find something else to do with your time and money. I've given you the foundation. I've explained how market timing actually works, why it's crucial, and what separates good timing from bad. But understanding these concepts intellectually is just the beginning. Now comes the hard part. Now comes the implementation, the practice, the grinding work of developing this skill through repeated exposure to real market conditions. There are no shortcuts. There are no magic indicators that will do this for you. There's just you, the market, and the choices you make in the moment. Choose wisely. Choose based on probability rather than emotion. And you'll give yourself a fighting chance. Choose poorly. Let your emotions drive your decisions, and you'll join the vast majority of traders who never make it past their first year. The market is waiting. It doesn't care whether you succeed or fail. It will present opportunities to those who are prepared to see them and seize them at the right moment. It will punish those who enter at the wrong times, who chase moves out of fear of missing out, who let hope and denial keep them in losing positions too long. The choice is yours. But make no mistake, if you don't master timing, you will keep losing money. That's not a threat. It's a simple statement of fact, proven over and over throughout market history. The question isn't whether timing matters. The question is whether you're willing to do what it takes to master it. And that answer will determine everything about your future as a trader. Now let me take you deeper into the mechanics of timing, because understanding the concept is one thing, but executing it consistently is another beast entirely. You see, most traders approach timing like it's a binary decision: either you're in or you're out. But that's not how professionals think about it. We think in terms of zones, of building positions gradually as evidence accumulates that we're right, and reducing positions gradually as evidence accumulates that the setup is failing. This concept of scaling is critical to proper timing, yet it's almost never discussed in trading education material because it doesn't fit neatly into the simplistic buy here, sell there narrative that beginners want to hear. Think about how institutional traders operate. They're not putting their entire position on in one shot at one price level. They can't. Their size is too large. If they tried to buy 10 million shares at the market, they'd move the price against themselves before they filled half the order. So what do? They accumulate gradually. They build a position over hours, days, or even weeks, buying dips, absorbing supply, never showing their full hand to the market. Then, when they're fully positioned and ready for the markup phase, they step aside and let momentum traders chase the move higher, providing liquidity for their eventual exit. This is the game within the game, and if you don't understand it, you're playing checkers while everyone else is playing chess. As a retail trader, you have advantages that institutions don't have. You can move in and out of positions instantly. You can change your mind and be completely flat within seconds. You don't have to worry about moving the market with your orders. But most retail traders squander these advantages by acting like day traders on cocaine, jumping in and out of positions on a whim, never giving good setups time to develop, never building positions strategically. They treat trading like a video game where the goal is to make as many trades as possible, when in reality, the goal is to make as much money as possible, which usually means making fewer, better trades. Here's how I think about scaling into positions. When I identify a high probability setup that meets all my criteria, I don't immediately put my full position size on. I start with a pilot position, maybe 1/3 to 1/2 of my intended full size. This is my test. I'm dipping my toe in the water to see how price responds. If I'm right, and price immediately starts moving in my favor, I'll add to the position on the first pullback, increasing my size as my confidence grows and my size. Initial entry becomes profitable, giving me a cushion. If I'm wrong and price goes against me, I'm only risking a fraction of what I would have risked if I'd gone all in immediately. This approach does two critical things. It reduces my risk on trades that don't work out, and it improves my average entry price on trades that do work out. Over hundreds of trades, this single technique can be the difference between marginal profitability and substantial returns. The key to making this work is having clearly defined levels where you'll add to your position and clearly defined levels where you'll abandon the setup entirely. You can't just wing it. You need a plan before you enter, and you need the discipline to follow that plan regardless of how you feel in the moment. Let's say you're looking at a breakout setup. Your initial entry might be on the first test of the breakout level with strong volume, while price is still within the consolidation. Your add point might be on a successful retest of the breakout level as new support. Your stop loss is below the consolidation, meaning if price breaks back into the range, you're wrong and you exit the entire position. Your profit target might be the measured move from the consolidation or a key resistance level above. Having this plan written down before you enter means you don't have to make emotional decisions in real time. You just execute the plan mechanically. This brings up another crucial aspect of timing that nobody talks about: the timing of your exits. Everyone obsesses over entries because that's the exciting part. But the truth is that your exit determines your profit or loss, not your entry. You can enter at a mediocre price and still make money if you exit well. You can enter at a perfect price and still lose money if you exit poorly. Yet most traders spend 90% of their time thinking about entries and 10% thinking about exits, when it should be closer to 50-50, or even weighted toward exits. There are three types of exits you need to plan for before you enter any trade. First, your stop-loss exit where you're wrong and need to cut the position to prevent further damage. Second, your profit target exit where you've achieved your objective and it makes sense to take the money and move on. Third, your trailing stop exit where the trade is working beyond your initial expectations and you want to let profits run while protecting gains. Most traders only think about the first one, And even then, they often move their stops or remove them entirely when price approaches, turning what should be small losses into disasters. Your stop-loss placement is actually a timing decision, not just a risk management decision. Where you place your stop tells you something important about your entry timing. If you have to place your stop very far from your entry to avoid normal market noise, that's a red flag that you're entering at a suboptimal time. The best entries allow for tight stops because you're entering at an inflection point where price should immediately start moving in your favor if you're right. If you need a wide stop, you're probably entering in the middle of a move rather than at the beginning of one, and that's a timing error. I learned this lesson the hard way, watching small losses turn into big losses because I entered at wrong times with wide stops, hoping the market would eventually come back my way. Hope is not a strategy. Tight stops at logical levels are a sign that your timing is good. Profit targets are trickier because you never know how far a move will go. A move that looks extended and ready to reverse can keep going for days or weeks. A move that looks like it's just getting started can stall and reverse without warning. This is where most traders torture themselves, exiting too early and watching profits evaporate, or holding too long and watching profits turn into losses. The solution is to have a systematic approach. I typically take partial profits at my initial target, maybe half my position, then trail a stop on the remainder to let it run if the move continues. This way, I'm guaranteed to capture some profit if I'm right, but I'm also positioned to capture extraordinary profits if I'm really right. It's a compromise, but it's a compromise that works over many trades. The trailing stop is your friend if you use it correctly. It allows you to stay in winning trades while protecting accumulated profits. But you can't trail too tightly, or you'll get shaken out on normal volatility. You can't trail too loosely, or you'll give back too much when the trade finally reverses. I typically trail based on market structure supporting my stop to below recent swing lows on an uptrend, or below major moving averages that have been respected throughout the move. The exact technique matters less than having a technique and following it consistently. What kills traders isn't the technique itself. It's the abandoning of the technique when emotions take over. Let me tell you about the concept of market rhythm, because this is fundamental to timing, and it's something you can only learn through experience. Every market has a rhythm, a characteristic way it moves based on the participants involved and the time frame you're trading. The stock market has a different rhythm than the commodity markets. Individual stocks have different rhythms based on their liquidity and volatility. Even the same stock will have different rhythms in different market conditions, a tight, choppy rhythm during consolidations and a smooth, trending rhythm during strong moves. Learning to feel this rhythm is essential to good timing. When you're in sync with the market's rhythm, trading feels easy. Your entries work. Your exits make sense. You can sense when to be aggressive and when to be defensive. When you're out of sync with the market's rhythm, everything is hard. You're constantly getting stopped out. Your entries immediately go against you. Your exits are either too early or too late. This is usually a sign that market conditions have changed and your approach needs to adjust. Maybe the market has shifted from trending to choppy, or from low volatility to high volatility, and the techniques that worked last week don't work this week. Recognizing these shifts quickly and adjusting your approach is another form of timing that separates professionals from amateurs. One of the most important rhythm shifts to recognize is the transition from a choppy, range-bound market to a trending market. In choppy markets, the best approach is to fade extremes, sell near the top of the range, buy near the bottom of the range, take quick profits. But if you continue this approach when the market breaks into a trend, you'll get destroyed. You'll be shorting the top of the range just as it breaks higher, or buying the bottom of the range just as it breaks lower. You need to recognize the breakout quickly, admit you're on the wrong side, flip your position, and ride the trend until it shows signs of exhaustion. This takes mental flexibility that most traders don't have. They get locked into one view of the market and can't adjust when conditions change. The opposite transition is equally important, recognizing when a trending market is shifting into a choppy, range-bound market. This is where trend followers get killed. They've been making money riding the trend, so they keep trying to buy dips or sell rallies, expecting the trend to continue. But now those dips and rallies are just moves within a range, and they're entering at exactly the wrong times, buying the top of the range and selling the bottom of the range. They give back all their profits and more because they can't recognize that the game has changed. The key is to notice when the character of the price action changes, when momentum starts to wane, when breakouts start to fail, when the market stops making progress in the direction of the trend. These are signs that it's time to shift strategies or step aside entirely. Stepping aside is itself a timing decision, and it's one that most traders never make consciously. They feel like they should always be in a position, always have something working, because otherwise they're not really trading. This is a fundamental misunderstanding of what professional trading is about. Professional trading is about deploying capital when conditions are favorable and sitting on your hands when they're not. It's about recognizing that there are times when the market is offering high probability opportunities and times when it's not, and adjusting your activity level accordingly. The best traders I've known spent the majority of their time waiting, not trading. They were patient predators, conserving energy, watching for that perfect moment to strike. When it came, they committed fully. Then they went back to waiting. This patience is unnatural for most people. We're wired to want constant action, constant stimulation, constant progress. The market exploits this tendency mercilessly. It rewards patience and punishes impulsiveness. It rewards those who can sit through boredom and uncertainty, waiting for their pitch. It punishes those who need constant action and trade just to feel like they're doing something. If you can't develop this patience, you need to find a different way to make money, because trading will systematically extract wealth from you through 1,000 small impulsive decisions that seem insignificant in the moment but add up to substantial losses over time. Here's another timing principle that took me years to learn. The best time to trade is when you don't need to trade, when you're desperate. When you need to make money to pay bills or recover losses, your timing will be terrible. You'll force trades that aren't there. You'll hold losers too long hoping they'll come back. You'll exit winners too early because you need to lock in profits. You're trading from a position of weakness, and the market can smell weakness. Conversely, when you're patient, when you have capital available but feel no pressure to deploy it, your timing improves dramatically. You can wait for the perfect setup. You can let profits run. You can cut losses quickly without emotional attachment. You're trading from a position of strength, and that strength translates into better decisions and better results. This is why proper position sizing is actually a timing tool. If your positions are too large relative to your capital, every normal market wiggle becomes emotionally charged. You can't think clearly. You can't execute your plan. Your timing falls apart because you're too scared or too excited. But if your positions are appropriately sized, where a stop loss is disappointing but not devastating, you can remain objective. You can execute your plan. Your timing improves because you're not trading from emotion. Most traders blow up not because their analysis was wrong, but because their position size was too large, causing them to make emotional timing errors they never would have made with properly sized positions. Let me share with you one of the most valuable timing techniques I've ever learned. And it's so simple that most traders dismiss it. Before you enter any trade, ask yourself, can I afford to be wrong? Not financially, we've already covered position sizing. I mean mentally and emotionally. If this trade goes against you, will you be able to cut the loss cleanly and move on? Or will you be so attached to being right that you'll hold and hope and eventually turn a small loss into a disaster? If you can't honestly say that you'll take the loss without drama, don't enter the trade. Your timing is already compromised by your emotional state. Wait for a setup that you can approach objectively, where you genuinely don't care whether it works or not because you've got 10 more setups waiting. That detachment, that emotional neutrality, that's when your timing is at its best. This principle extends to scaling out of positions as well. Most traders struggle with taking profits because they're afraid of being wrong, afraid of exiting too early, and missing out on additional profits, gains. This fear compromises their exit timing. They hold positions too long, watching profits shrink or disappear entirely because they can't pull the trigger. The solution is to remove the emotional weight by taking partial profits. Once you've locked in some gain, you've already won. Now you can let the rest run with a clear mind. or you can exit the remainder at any point without regret. This technique of taking partials transforms your psychology around exits, which directly improves your timing. The cumulative effect of all these timing decisions, your entry, your position sizing, your adds, your partial exits, your trailing stops, your final exits determines your overall trading results. Two traders can have the exact same setups, the exact same market read, but completely different results based purely on the timing of their execution. One enters too early and gets shaken out before the move begins. The other enters at the optimal point and rides the entire move. One sizes too large and exits from fear. The other sizes appropriately and executes the plan flawlessly. These timing differences compound over hundreds of trades to create massive divergences in outcomes. This is why you can't just copy someone else's trades and expect to get their results. The timing of every decision matters, and that timing comes from your own psychology, your own experience, your own discipline. So when someone asks me what the secret to trading success is, I don't talk about indicators or strategies or market theories. I talk about timing. I talk about developing the skill to recognize when probability is in your favor and the discipline to act on that recognition. I talk about the patience to wait for these moments and the courage to commit when they arrive. I talk about the mental flexibility to adjust when conditions change and the emotional control to execute your plan regardless of fear or greed. These are timing skills, all of them, and they're far more important than any technical pattern or indicator you could ever learn. Master these, and you'll make money in any market, with any approach. Fail to master these, and it doesn't matter what strategy you use, you'll keep losing money until you either quit or finally learn what I'm teaching you right now. Now, I want to address something that's probably been nagging at you this entire time. You're thinking, this all sounds great, but how do I actually practice these timing skills? How do I develop this intuition without blowing up my account in the process? That's a legitimate question, and it's one that deserves a thoughtful answer, because the learning curve in SASPET, trading is brutal and expensive if you approach it wrong. Most traders treat their live account like a video game, taking random trades, learning nothing from their losses, and eventually quitting when their money runs out. There's a better way, but it requires structure and discipline. 2. Qualities most traders lack. First, you need to start with observation, not participation. Before you risk a single dollar, you need to spend time watching markets, recording potential setups, and tracking how they play out. I'm not talking about paper trading where you pretend to take trades and pat yourself on the back for pretended profits. I'm talking about genuine market observation where you identify setups, note what makes them attractive, predict how they'll play out, and then watch without any emotional stake in the outcome. Do this for several months, and you'll start to build a mental database of what works and what doesn't. You'll see patterns emerge. You'll notice that certain setups work in certain conditions and fail in others. You'll develop a sense for market rhythm without risking any capital. This is the foundation. Once you've done this groundwork and you have a clear edge that you've documented through observation, then and only then should you start trading with real money. But start small, ridiculously small. Small enough that a loss doesn't bother you emotionally at all. Why? Because you're not trying to make money at this stage. You're trying to execute your plan flawlessly while money is on the line. You're trying to discover the psychological differences between watching a trade and being in a trade. You're trying to identify the emotional patterns that cause you to deviate from your plan. If you start with large positions, you'll be too emotional to learn anything. You'll just repeat the same mistakes over and over because you're in survival mode rather than learning mode. Keep a detailed journal of every trade, not just the entry and exit prices, but your thought process. What made you take the trade? What was your plan? How do you feel during the trade? Where did you deviate from your plan, if at all? What would you do differently? This journal is more valuable than any trading book you could read because it's a record of your own psychology, your own patterns, your own edge taking shape. Review it weekly. Look for patterns in your behavior. Are you consistently exiting winners too early? Are you holding losers too long? Are you entering before your setup is complete because you're impatient? These patterns will reveal themselves if you're honest in your journaling, and once you see them clearly, you can work on correcting them. The hardest part of this process is being honest with yourself. It's so tempting to rationalize bad trades, to make excuses, to blame the market or bad luck or some external factor. But the market doesn't care about your excuses. Either you're making money or you're losing money. And if you're losing money, something in your approach needs to change. The traders who succeed are the ones who can look at their results objectively, identify their weaknesses brutally, honestly, and systematically work to correct them. The traders who fail are the ones who keep making the same mistakes, blaming external factors, convinced that eventually luck will turn their way. It won't. The market isn't random. It rewards skill and punishes mistakes consistently over time. Another crucial aspect of developing timing skills is specialization. Most traders try to trade everything: stocks, futures, forex, crypto, all at once. They jump from strategy to strategy, time frame to time frame, market to market, never developing deep expertise in anything. This is a recipe for mediocrity at best. The best traders I've known specialized ruthlessly. They picked one market, one strategy, one time frame, and they became absolute experts in it. They could sense subtle shifts in their chosen market that others couldn't see. They knew how their market behaved in different conditions because they'd watched it obsessively for years. This deep specialization gave them a timing edge that generalists could never match. Think about it logically. If you're trying to track 20 stocks across 3 time frames using 4 different strategies, how can you possibly develop the deep pattern recognition necessary for excellent timing? You're spread too thin. You're constantly context switching. You never develop that intimate feel for how your market moves. But if you focus on 3 stocks that you watch every single day, studying their behavior, noting how they react to news and market conditions, observing the patterns that repeat, you'll develop an edge in those 3 stocks that's real and sustainable. You'll start to sense when something is off, when the rhythm has changed, when an opportunity is forming. This is the kind of edge that matters, and you can only develop it through focused, specialized observation over time. This principle of specialization applies to time frames as well. Day trading requires completely different skills and psychology than swing trading, which is completely different from position trading. The patterns are different. The risk management is different. The mental demands are different. Trying to do all 3 simultaneously is like trying to be a professional sprinter, marathoner, and powerlifter at the same time. Pick one, master it. Then, if you want to expand, you can add another time frame or strategy. But trying to do everything at once is why most traders never achieve consistency in anything. Let's talk about the role of technology in timing, because this is where a lot of modern traders get seduced by false promises. They think that if they can just find the right indicator, the right algorithm, the right automated system, they won't have to develop these skills themselves. The machine will do it for them. This is a fantasy. I'm not saying technology is useless, far from it. Good charting software, reliable data feeds, fast execution, these are all valuable tools. But they're just tools. They don't replace judgment. They don't replace experience. They don't replace the ability to read context and make split-second timing decisions based on incomplete information. The problem with algorithmic approaches to timing is that markets are not purely mechanical systems. They're made up of humans, making decisions based on incomplete information, fear, greed, hope, and desperation. These psychological forces create patterns, yes, but they're not perfectly regular patterns that can be captured by simple rules. The patterns evolve. They work until they don't. What worked in one market regime fails in another. An algorithm can't sense these shifts the way an experienced trader can. An algorithm can't feel that something is off, that the market character has changed in a subtle way that hasn't quite shown up in the data yet. This is why fully automated trading systems tend to work for a while and then stop working. Why the holy grail of set-it-and-forget-it algorithmic profits remains elusive for most traders. What technology can do is augment your decision-making. It can help you scan for setups that meet your criteria. It can help you backtest ideas to see if they have statistical merit. It can help you execute trades quickly and reliably. But the core timing decisions, when to enter, how much size to use, when to add, when to exit, these require human judgment informed by experience. The goal isn't to eliminate your involvement through automation. The goal is to develop your skills to the point where your timing decisions are consistently profitable. Then use technology to execute those decisions efficiently. Here's a timing concept that nobody teaches: the importance of timing your trading activity to your own mental and physical state. You're not a machine. Your decision-making ability varies throughout the day, throughout the week, based on how rested you are, how stressed you are, how clear your mind is. If you're exhausted, distracted, emotional, or unwell, your timing will suffer. You'll miss signals you'd normally catch. You'll take trades you'd normally pass on. You'll exit at the wrong times because you're not thinking clearly. Professional traders understand this. They know when they're at their best, and they concentrate their trading activity during those times. They know when they're off, and they step aside entirely, rather than forcing trades with compromised judgment. I learned this lesson the hard way, taking stupid losses late in the day when I was exhausted, or forcing trades when I was emotionally upset about something unrelated to the market. Now I have rules about when I trade and when I don't. If I'm not well rested, I don't trade. If I'm emotionally agitated, I don't trade. If I'm distracted by personal matters, I don't trade. It's not worth it. The market will be there tomorrow. Missing one day of opportunities is nothing compared to the damage you can do to your account by trading with compromised judgment. This is another form of timing your participation to when you're capable of performing at your best. Let's discuss the timing of position management, because this is where many traders lose money, even when their initial entry timing is good. They enter a trade at the right time, the position moves in their favor, and then they proceed to mismanage it through poor timing decisions. Maybe they take profits too early out of fear. Maybe they hold too long and watch profits evaporate. Maybe they add to the position at the wrong time, increasing their risk just before a reversal. Maybe they move their stop loss further away when price approaches it, turning a small loss into a large one. All of these are timing errors in position management, and they're often more costly than entry timing errors. The key to good position management timing is having a plan before you enter, and the discipline to follow it. But your plan also needs to be flexible enough to adapt to how the trade actually unfolds, because markets don't read your script. If a trade moves in your favor more quickly than expected, that might actually be a warning sign of a climactic move that's about to reverse. If a trade moves in your favor more slowly than expected, grinding higher over days with constant small pullbacks, that might be a sign of strong hands accumulating, suggesting the move has legs. You need to be able to read these signals in real time and adjust your management accordingly, while still maintaining overall discipline and risk control. Here's a specific example. Let's say you enter a long position expecting a breakout, and within an hour, the stock has gapped up 5% on massive volume. Your plan was to hold for a 10% gain over a few weeks. What do? Many traders would just stick to the plan rigidly. I said 10%, so I'll hold for 10%. But that might be a timing error. The rapid climactic move suggests exhaustion, not strength. Smart timing would be to take at least partial profits immediately, locking in the quick gain, then potentially re-entering if the stock consolidates and shows signs of continuing higher. Rigid adherence to your plan without reading the actual market action is just another form of poor timing. Conversely, if your trade is working but slowly, grinding higher with healthy pullbacks and consolidations, that's a sign of persistent buying pressure. This is when you want to give the trade room to breathe, not cut it short because you're impatient. The timing decision here is to hold, to let the trade develop fully, even if it takes longer than you initially expected. Many traders do the opposite. They lose patience with slow-moving winners and cut them short, while they stubbornly hold fast-moving losers hoping for a reversal. This is backwards. You want to be patient with your winners and ruthless with your losers. But executing this in real time, when emotions are running high, is where most traders struggle. The solution is to create decision rules that remove emotion from the equation. For example, if a position moves 10% in my favor in less than one day, I will take at least half off the table immediately, regardless of my initial profit target. Or, if a position is in profit but moving slowly, I will hold as long as it remains above its 20-day moving average, regardless of how long it takes to reach my target. These kinds of rules provide structure for your timing decisions while still allowing flexibility, based on actual market behavior. Over time, you refine these rules based on what works in your market with your strategy. Another timing consideration that's often overlooked is the timing of your position sizing adjustments. Most traders think of position sizing as static. You decide your size before you enter, and that's that. But professional traders adjust their size dynamically based on market conditions and their recent performance. When market conditions are favorable and they're trading well, they increase their size to capitalize on the good conditions. When market conditions are tough or they're in a drawdown, they reduce their size to preserve capital and reduce psychological pressure. This dynamic sizing is itself a timing decision, timing your aggression to when conditions favor it, and your caution to when conditions demand it. I've seen traders destroy themselves by maintaining the same position size regardless of conditions. They're in a drawdown, their confidence is shaken, the market is choppy and difficult, and yet they keep taking the same size positions, digging themselves deeper into a hole. The correct timing decision would be to dramatically reduce size, take only the highest probability setups, rebuild confidence and capital, then gradually increase size as conditions improve and their performance recovers. But ego gets in the way. They want to make back their losses quickly, so they maintain or even increase their size, turning a manageable drawdown into a catastrophic loss. The opposite mistake is staying too conservative when conditions turn favorable. The market shifts into a beautiful trending environment. Setups are working left and right, and yet they're still trading small size out of lingering fear from the previous drawdown. They miss the opportunity to make significant profits when everything is working in their favor. Proper timing means recognizing these shifts quickly and adjusting your approach accordingly. Aggressive when warranted, conservative when necessary, always appropriate to current conditions rather than stuck in a stance that made sense last month but doesn't fit today. Here's a final timing principle that ties everything together: the importance of timing your learning and adaptation. Trading is not a skill you learn once and then execute mechanically forever. Markets evolve. What works today might not work tomorrow. Volatility regimes change. Correlations break down. New technologies emerge. Regulations shift. If you're not constantly learning, constantly adapting, constantly refining your approach, you're falling behind. But there's a timing element to this too. You don't want to abandon a working approach at the first sign of difficulty. You don't want to constantly chase new strategies every time you hit a rough patch. But you also don't want to stubbornly stick with something that's clearly stopped working. The timing question is, when do you adapt and when do you persist? This requires honest assessment. Is your approach not working because market conditions have changed, or because you're not executing it properly? Is the drawdown a normal fluctuation within the expected range of your strategy, or is it a signal that something fundamental has shifted? These questions don't have easy answers, but they're critical to long-term success. The traders who last decades in this business are the ones who can recognize when adaptation is necessary and when persistence is necessary, and who have the courage to act accordingly even when it's uncomfortable. In my own career, I've had to adapt numerous times. Strategies that made me fortunes eventually stopped working. Markets I dominated changed character. I had to learn new approaches, new markets, new ways of thinking about timing and risk. Each transition was painful. It's hard to abandon something that worked, even when the evidence is clear that it's not working anymore. But the alternative is to slowly bleed money holding on to outdated approaches while the market moves on without you. The timing of these strategic shifts, knowing when to adapt and what to adapt to, that's perhaps the highest level of timing skill there is. So here we are. I've given you everything I know about timing. I've explained the mechanical aspects, how to identify entry points, how to manage positions, how to time exits. I've explained the psychological aspects, how to remain disciplined, how to manage emotions, how to develop the patience necessary for excellent timing. I've explained the strategic, Aspects how to specialize, how to adapt, how to approach learning in a way that actually builds skill rather than just burning through capital. The question now is what you'll do with this information. Will you take it seriously, implement it systematically, and do the hard work necessary to develop these skills? Or will you skim through it, think, that's interesting, and then go back to making the same timing mistakes that have been holding you back? The choice, as always, is yours. But I promise you this, if you master timing, really master it, you'll never look at trading the same way again. And more importantly, your results will reflect that mastery in the only way that truly matters. Consistent profits that compound over time, turning small accounts into large ones, turning uncertain beginnings into secure futures. That's what timing can do for you. Now go out there and do the work to make it happen.